Hello everyone, welcome to this fourth day of the APM webinar for the December 2020 examination session. This is Luqman Rafiq, tutor for the paper APM. We have had good 4-5 days, the 3 days of this specific webinar. And what we would be doing now is we are now heading into the fourth day of this specific webinar. What I'll be doing is I will be going through the various areas with the which are important from the perspective of the exam in today's session. So let me actually share a few things with you. I am assuming that a lot of you people have already got the handouts either through the email or through the WhatsApp groups, and that you people have already gotten those things. So what we would be doing in today's session is going to be, we will be going through the economic value added. We will be going through the divisionalization area. And in addition to the divisionalization area, what we would also be doing is, we would be going through a few of the exam practice questions on this area also. So let me share this. In fact, I think there are many handouts which are already available. So you could probably have a look at this specific handout, which is pertaining to value-based management, which is pertaining to the economic value added, which is pertaining to another part of the economic value added article that the examiner had published some time back. Okay, now let me know that how many of you have already studied this economic value added. How many of you have already studied the economic value added? How many of you are comfortable with the economic value added technique? Yeah, how many of you have already studied the economic value added? How many of you are comfortable with the economic value added technique? Okay. Studied but not sound grip, studied but not comfortable. Okay, now great. So what I'm going to do is that I'm going through this specific economic value added technique. I'll teach you this specific economic value added technique in such a manner, assuming that you haven't studied it. So that's what I'll be doing. Now, let me start off. The first thing is, let me guide you that the topic that of the economic value added that we are going to be discussing. There are a few things that you would have to keep in mind with respect to the economic value added. And what exactly are those things? First of all, so if I talk to you about this economic value added, I'm assuming that all of you do remember that we have got two of the performance measures which are used a lot with respect to the divisional structure. And what exactly are those two performance indicators that are used a lot with respect to divisional structure? Those performance indicators are termed as residual value, and those performance indicators are termed as uh, this return on investment. So If I could just quickly recall the formula for the return on investment, and if I could quickly recall the formula for the residual income, so we can have a better discussion on the economic value added, because the concept of the economic value added is actually connected with this specific residual value Testing 1 2 3. I hope that I'm audible now. Am I audible now? Yeah, am I audible now? Yeah, am I audible now? Okay, okay, good enough. Alhamdulillah. Now, coming back to it, so unfortunately, I had to switch my PC. I don't know what happened, that the sound all of a sudden was lost. But anyways, let's actually start discussing further. So I'm going to start from the scratch because I know I'm assuming that there was a lot of disturbance which would have made it very difficult to understand. So I'm going to start from the scratch. Okay, now the topic that I'm going to start off, the name of the topic is economic value added. Let's talk about the concept of economic value added. Let's talk about the concept of economic value added. The background to the economic value added is we have a formula for the economic value added, and the formula for the economic value added is NOPAT, which is the net operating profit after tax less the weighted average cost of capital multiplied by the capital employed. The weighted average cost of capital multiplied by the capital employed. Now, let's just start discussing this. So what exactly is the formula for the economic value added? The formula for the economic value added is it's NOPAT, the net operating profit after tax, less WACC into capital employed. Now, when we talk about this NOPAT, so this NOPAT is actually net operating profit after tax. It's net operating profit after tax. And the WACC is your weighted average cost of capital. The WACC is your weighted average cost of capital. And then you've got this capital employed, which is simply the total assets minus current liability, or you could do it like this, which is the equity plus non-current liability. That is all going to be considered as your weighted average cost of capital. Now let's talk and let's discuss further. So the first thing that we need to understand is basically that this is the formula for the economic value added. Now, if this is the formula for the economic value added, what was the reason behind introducing this formula? What are the components of this specific formula? How do we establish NOPAT? How do we establish the WACC? How do we establish the capital employed? Let's have a quick discussion about all these. The first thing that you need to keep in mind is basically that there are various performance measures, and amongst the various performance measures, there were one of the performance measure which was quite famous amongst the entity, and that performance measure is termed as a residual income. Amongst the various performance measures, there was one of the performance measures which was quite famous amongst the users, and that was actually the residual income. Now, what exactly do you mean by this concept of residual income? The formula for the residual income, since the residual income was majorly used for the divisions, so the formula for the residual income is the divisional profit. The formula for the residual income is the divisional profit. And from the divisional profit, what you do is that you say that there is basically the investment multiplied by desired return, multiplied by desired return. Now, so for example, if you've got a division which has got a profit of, let's say, 100,000, and you've invested, let's say, 500,000 into that specific division. So if you've invested 500,000 into that specific division and your desired return is 12%, So resultingly what happens is it's going to be 100,000 less 500,000 into 12 gives you 60,000. So hence this is going to be 40,000. So this specific measure of the residual income was a very common and a very famous performance measures amongst the various performance management analysts. But when we talk about this specific measure, which is the residual income measure, there are multiple problems with respect to this residual income measure. What are those multiple problems with the residual income measure? We are going to discuss them one by one. First of all, this residual income of 40,000 tells you what? If there is a positive residual income, that means the business has generated the returns exceed the desired return. The returns exceed the desired return, that's what it is. The second thing is, if there is a zero residual income, this would mean the returns equal desired return. And the third one of them is basically, if this is negative, that means the returns are less than the desired return. So when we talk about the residual income as a performance measure, so with respect to the residual income, what actually happens is, let me repeat, when we talk about the residual income as a performance measure, so generally speaking, what happens is that if your residual income is either positive or is residual income either zero, so you would say that the division or the segment or the branch is performing well. But if it is negative, then you would say that it's not performing well. If it's negative, then you would say that it's not performing well at all. Now let's move a bit forward and let's discuss a bit further. Now, so first of all, how do you interpret the residual income? We talked about it. How do we interpret the residual income? We talked about it. The next aspect is basically to be able to understand. Let me repeat. The next aspect is that we should be able to understand that what exactly were the components of the residual income. So when you talk about the residual incomes component, one of them is basically a divisional profit. Now, the problem that used to arise with respect to this divisional profit was that the divisional profit is made up of many non-cash items. And if you are evaluating the performance of the business using the non-cash items, let me repeat. If you are evaluating the performance of the business using the non-cash items, then automatically what is actually going to happen is, let's try to have an understanding that if you are evaluating the performance of the business using the non-cash items, then what is actually going to happen is that is going to give you an incorrect picture of how the business is performing. That is going to give you an incorrect picture of how the business is performing. Okay, now the next thing is basically, so this was one of the problems with respect to the divisional profit, that the divisional profit is actually one of those measures that actually includes the non-cash items. Now, the next another thing that was actually there was basically that when it comes to the computation of the residual income, you incorporate the desired return. Now, basically what happens is the desired return of the management could be anything. Let me repeat, the desired return of the management could be 20%, could be 25%, could be 30%, could be 40%. That's what the desired return of the management is going to be. Let me repeat, The desired return of the management could be anything, 20%, 25%, 30%, 40%. But it's not necessary that the desired return that the management is a realistic return. It's not necessary that the desired return of the management is a realistic return. So basically, in order to overcome this specific issue, what was actually introduced was the EVA introduces the concept of using the WACC. Because you see, the WACC, it's a reflection of the capital employed. It's a reflection of the investor, or it's a reflection of the providers of finance. So the return that is actually desired by the providers of finance, that is reflected through the WACC. So it's going to be better off that the entity uses WACC instead of the desired return, then etc. etc. So in order to overcome the limitations that are being available with respect to this residual income, the concept of the economic value added was introduced. And the formula for the economic value added is this, which is the NOPAT, the net operating profit after tax, less the WACC into capital employed. Why exactly was this specific formula introduced? This specific formula was introduced with a purpose, with an objective. And what was the objective? To overcome the limitations of the residual income as a performance measurement tool of any specific organization. So is everyone okay till now? Yeah, is everyone okay till now? Okay. The economic value was introduced in order to overcome the limitations of residual income. What were the limitations of residual income? The limitations of residual income were basically that, first of all, there was this divisional profit that was being used. When the divisional profit is being used, so what actually happens with respect to the divisional profit is that, let me repeat. What happens with respect to the divisional profit is that, what happens with respect to the divisional profit is that basically divisional profits include non-cash items also. And if you incorporate the non-cash items also, then what happens is the incorporation of the non-cash item would actually mean what? Would actually mean that the profit appropriate that the calculation for the profit, that the calculation of this excess profit is not an appropriate one. Similarly, here there was a use of desired return. The desired return could be anything which could be unrealistic. So it's better off that you use the weighted average cost of capital instead of the desired return. So for this specific reason, for keeping this specific thing in mind, the concept of the economic value added was introduced. The concept of economic value added was introduced. Now, let's move a bit forward and discuss further. So if I move a bit forward, let's discuss that how exactly do we calculate the NOPAT. Let's discuss that how exactly do we calculate the NOPAT, how exactly do we establish the capital employed, and how exactly is this whole calculated. Now, if I'm going to calculate the NOPAT, what actually happens is that there is a specific method for the computation of NOPAT. Now, what exactly is that? Let me write it down, and then we are going to move a bit forward. Okay, so let's talk about this NOPAT now. Okay, now Ramesh, you have a question that why exactly are we using the weighted average cost of capital? So we're using the weighted average cost of capital because what actually happens is that weighted average cost of capital reflects the actual return which is desired by the providers of finance. Now, how exactly do we calculate the NOPAT? Let's try to have a discussion of the NOPAT. So what we do is that we start off with either the operating profit, which is also the profit before interest and tax. After that, what we do is that we incorporate the adjustments to it. Now, what exactly are the adjustments that we incorporate? So let's try to have an understanding of this. We apply tax, okay. So I have actually written the computation of the NOPAT in front of you. The NOPAT actually means the net operating profit after tax. And when it's net operating profit after tax, let's try to have an understanding that how do we calculate this NOPAT for the purposes of the computation of, the economic value added, for the purposes of computation of economic value added. Now, there is one more adjustment that I would probably do, and that's actually the operating lease rentals and depreciation on assets. Okay, so this is increase, decrease in provision. Now let's try to discuss. First of all, let's keep in this mind that you are trying to establish NOPAT. And the concept of establishing NOPAT is that the NOPAT is majorly a cash figure. The concept of establishing NOPAT is that the NOPAT is actually a cash figure. Now, when we talk about the NOPAT being the cash figure, so is it actually a cash figure? The answer is no. It's a sort of an economic profit that we are trying to establish. It's a sort of an economic profit that we are trying to establish. Now, how does it go about? So the starting point is the PBIT, the profit before interest and tax. Assume that you've got a profit before interest and tax of 400,000. What you're going to do is that you're going to apply the tax rate. Let's say 20% is the 25% is the tax rate. So you directly apply the tax rate onto it. So if 400,000 into 25%, this actually gives you 100,000. This 300,000 figure is going to be named as PBIT. This is going to be named as PBIT 1 minus T. What is this going to be named as? PBIT 1 minus T. So how do we start calculating it? We say that operating profit, okay. Then what you need to do is that you need to deduct the taxation. You need to directly apply taxation to it. How much? Whatever the tax rate is, you apply the tax. Then what happens is you end up getting PBIT 1 minus T. Now let's move a bit forward. The next thing that we do is that we add back few things. We add back accounting depreciation. Why? Because the accounting depreciation is a non-cash expense. The accounting depreciation is a non-cash expense. So let's say that if the accounting depreciation is 150,000, it has already been deducted from this profit. So you need to add back the accounting depreciation. You need to add back the accounting depreciation. Now, there is somebody, John Mupai, you are asking that is there an adjustment on interest? I'll tell you, don't worry. There's another one, Tori called Byron. What is eligible for capitalization? What is eligible for? Okay, just wait a bit. Now, so let me go through each and every part, and then you can ask whatever questions that you may have. So I said that you start off with an operating profit, let's say whatever that is. You apply taxation to it. Resultingly, what happens is the accounting depreciation is established, and then what happens is there is a concept of economic depreciation. What exactly do you mean by economic depreciation? Try to understand this. When we talk about the asset, so there are actually two types of life of an asset. One of them is a useful life, and the other one of them is termed as an economic life. Let me discuss. One of them is a useful life. The other one of them is an economic life. Now, when we are going to be calculating this useful life, the useful life and the economic life, the major difference is the economic life is the maximum period over which asset will provide benefit. Over which asset will provide benefit, that is considered to be economic life. And the useful life is the period over which an entity intends to take benefit. So there are two things. One of them is a useful life, the other one of them is an economic life. If I talk about the useful life, it's a period over which an entity intends to take the benefit, and the economic life is the maximum period over which an asset can give you benefit. Like for example, if I talk about the useful and the economic life example, an asset may give you benefit for 10 years, but as an entity, you may have a policy of using it for 4 years only. So if as an entity, you have a policy of using it for 4 years only, so that means the useful life is 4 years. Now, let's try to understand this. The accounting depreciation is established over useful life. So that means if the asset was 100,000, if the useful life was 4 years, so the accounting depreciation is of 25,000. But if we try to calculate
If we try to calculate the economic depreciation of that asset, we are going to say 100,000 divided by 10. So 10,000 becomes the economic depreciation of that asset. Now, so the proponents of EVA, the people who introduced EVA, their viewpoint was, I'm repeating, the people who introduced EVA, their viewpoint was that the asset, when you use that asset, realistically speaking, the value of the asset declines over its economic life. It does not decline over its useful life. So therefore, what actually happens is you should deduct the accounting, you should add back the accounting depreciation, but whatever the economic depreciation, that means the depreciation computed over the economic life, that needs to be deducted. Why? Because that's a real consumption of the asset. The next thing is you need to add back all the non-cash expenses. I may have mentioned only few non-cash expenses. You may think of other non-cash expenses also. Whatever the impairment is there, that impairment is non-cash expense. Whatever the increase or decrease in provision for bad debts, again, that is considered to be a non-cash item. Deferred tax again is a non-cash item because the deferred tax is never settled. It's just a double entry that moves it. So if you've got a deferred tax, let's say 50,000 is the deferred tax, so you will have to add it up. Now what next is there? Let's discuss further. You've got the PBIT 1 minus T. The accounting depreciation needs to be added back. The economic depreciation needs to be deducted. The non-cash expenses needs to be added. Then there is something which is eligible for capitalization. Let's try to discuss this. You see, what happens is when we are dealing with the intangibles in accordance with IAS 38, usually what we do is that we expense out a lot of things. For example, the research cost, for example, the internally generated customer list, internally generated brands, we don't capitalize them. But the proponents of the economic value added, their viewpoint was that if you have got R&D costs, which is going to give you benefits for more than 12 months, then what should happen is it needs to be added back, because it is not going to be considered as an expense. It's rather going to be considered as an asset. Okay, let's move a bit forward and discuss further. The next thing is basically operating lease rentals. Now, what exactly do you mean by operating lease rentals? Let's try to have a discussion. When we talk about the operating lease rentals, let's try to understand, let's try to see this. The people who actually who talked about this economic value added, their viewpoint about this operating lease was, their viewpoint about the operating lease was that they actually mentioned this thing, that see, even if you are using a property and that property is actually on rent, if they are using a property and that property is actually on rent, then what actually happens is, if the property is on rent, this means that although you may be paying only 200,000 for the property, but realistically speaking, if this property is worth 20 million, so you are taking the advantage of 20 million from it. So if you are taking advantage of 20 million from it, therefore this property should be capitalized as part and parcel of your asset. Now try to understand this. Although the new IFRS, which is IFRS 16, talks about this. Let me repeat. The new IFRS, which is IFRS 16, talks about this. So if the IFRS 16 talks about this specific area, then what actually happens is, if IFRS 16 is talking about this specific area, what is this going to mean? What is it going to mean? This is actually mean that from the for the current circumstances, if an entity is applying IFRS 16, then whether an asset is on operating lease, whether an asset is on finance lease, it's always going to be capitalized. But if we talk about the old scenarios, and you might come across any of the old scenarios, you need to understand that if you have an asset which is worth 20 million and you are only paying a rental of 200,000, then ideally what happens is this should be treated as your capital employed. And if it is treated as your capital employed, so the rental expense should not be deducted. So therefore, whatever the operating cost rentals, they need to be added back. Let's say if this is 300,000, this needs to be added back. But yes, this asset on operating lease, their depreciation needs to be deducted because we are treating it as our own asset. And what sort of depreciation? The economics type of a depreciation. So when we talk about the computation of NOPAT, this is how you calculate NOPAT. This is how you establish NOPAT. How? The operating profit, you start off with operating profit, you reach this specific level. So if anyone is having any questions pertaining to it, anyone is having any issues with respect to it, do let me know. Are you able to understand the NOPAT calculations? If you have any queries pertaining to the NOPAT calculation, then let me know. Yes, I'm just waiting for your questions. There is going to be volume, just wait. I'm waiting for the questions of you people. Okay, so now we have got multiple questions. I was just waiting for the questions so that I could figure out that what are the different types of questions that you are having. Now let's just see. The first thing is, now there is one of the queries which is basically pertaining to one of the queries which is pertaining to the interest computation with respect to the NOPAT. So I need to get back to you. Okay, just wait. Okay, so okay, let me get back now. The last depreciation is for what? The last depreciation is for the asset which is on operating lease. Interest calculation issue. Okay, just wait. Please re-explain operating lease rentals. Okay, I'm going to explain why non-cash items are added with profit. Okay, is depreciation of leased asset? Yes, depreciation of leased asset. How to deal with it? Always find trouble and okay. Don't worry, I'm just going to come on to the question. Bit of confusion about, can you explain why? Okay, now let's get back. I think everybody is okay till now with respect to accounting depreciation, with respect to the economic depreciation, everybody gets it. The non-cash expenses are added back because we try to calculate economic profit, the realistic profit. We try to calculate the economic profit, which is the realistic profit. Now, so basically what happens is, if this is an economic profit, which is the realistic profit, what is this going to mean? What is this going to mean? So this is actually going to mean that this is actually going to mean that we are trying to incorporate whatever the realistic expenses are. That's why we added back the accounting depreciation, but we deducted the economic depreciation. We add back the non-cash expenses. We added back them. Now, the amount eligible for capitalization, although accounting standard says it should not be capitalized, but we are capitalizing it. Accounting standard says we should not capitalize, but we are capitalizing it. Now, so if we are going to be capitalizing it, now what next is there? The next situation is that we are going to be capitalizing it because we believe that if the R&D can give you benefit for more than 12 months, then it should be capitalized. For the operating lease rentals, try to understand this thing. You do know that operating lease means that the asset is not owned by us. It means just a normal rental agreement. So the proponents of this economic value added, their viewpoint is that you are using this property and you are only paying 200,000. But you are taking the benefit of the 20 million property. So if you are taking the benefit of 20 million property, what does that mean? What does that mean? This would actually mean that realistically speaking, you have a 20 million of the asset at your disposal. So you should add up this asset as your asset and your capital employed. And this property, the rental should be avoided just like if it's as your own property. And you should rather deduct the economic depreciation as if it's your own property. So the operating lease rentals should not be claimed. Rather, the depreciation on the operating lease asset should be claimed because we are treating it as if it's owned by us. Now, there is another question. What's the depreciation on asset and the, I mean, you see, I told you there are two types of depreciation. One of them is accounting depreciation. The other one of them is an economic depreciation. The accounting depreciation is when you depreciate over useful life. The economic depreciation is when you depreciate over the economic life. That's what the economic depreciation is. Okay, now is everyone okay with all the queries pertaining to the NOPAT calculation? There is one more pertaining to interest which I need to explain. So don't worry, I'll just explain the interest also. But are you people okay? Okay, let's move a bit forward and discuss further. Okay, Timothy, you're asking a question that what's the difference between the accounting depreciation and the depreciation on asset? Okay, let me say this thing. Economic depreciation on assets under operating lease. Economic depreciation on assets under operating lease. Okay, let's move a bit forward and discuss further. The next aspect of this specific EVA computation is the calculation of capital employed. The next aspect of the EVA calculation is the capital employed. Now, what exactly do you mean by the capital employed? There is a very important thing which you need to understand, that there are two capital employed. One of them is the opening capital employed, the other one of them is the closing capital employed. So remember, for the economic value added calculation, it's the opening capital employed that's going to be used. I repeat, for the computation of the economic value added, it's the opening capital employed that's going to be used. Now, if I talk about the opening capital employed, what does that mean? This would actually mean that if you are calculating the EVA for the year ended 31st December 2020, that means you would actually be needing the capital as at 1st January 2020 or as at 31st December 2019. You would have to keep this thing in mind. Now, how do we establish the capital employed? So you need to understand that. The capital employed is calculated using multiple methods, multiple manners. Okay, I'll repeat. I told you people that if you have to use the capital employed, what capital employed would you be using? Opening, closing, average, what? So you'll be using opening capital employed. Like if you are calculating EVA for the year ended 31st December 2020, if you are calculating EVA for the year ended 31st December 2020, that means what is actually going to happen is you will be using the capital employed for the opening. Opening means 1st January 2020, and this also means 31st December 19. So if the examiner gives you 31st December 19 capital, you will be using that. Okay, now, so first of all, let's try to understand how do we calculate the capital employed. One of the formula for the capital employed is you calculate the equity plus the non-current liability. The other way of calculating the capital employed is total assets minus current liability. So these are the two ways, these are the two methods of establishing the capital employed, which is the equity plus non-current liability, and the other one of them is total assets less current liability. Now, Let's move a bit forward. Let's discuss further. So what you need to do is that you need to calculate the adjusted capital employed. Now, what exactly do you mean by this adjusted capital employed for the EVA calculation? The adjusted capital employed means that capital as per the balance sheet. Then what would happen is you would say accounting depreciation to date. To date is from the day when the entity has started operation. Economic depreciation to date. The economic depreciation to date, that is from the date the entity has started operation. Then what happens is the intangible cost expense needs to be added back. The provisions non-cash expenses to date. And then what you are going to do is that fair value of the asset held under operating lease. Fair value of the asset held under operating lease. Fair value of the asset held under operating lease. Now, let's try to have an understanding that how exactly do we calculate all this. So it's basically, if you are trying to perform the calculation for the year ended, let's say 31st December 2020, that means you are calculating EVA for the time period 1st January 2020 to 31st December 2020. Now, so that means we are using this capital, and I told you this is equal to 31st December 19 capital also. Is that okay? So the adjustment that we are doing is we are doing adjustment to this capital. And if we are doing adjustment to this capital, this would actually mean that we are doing adjustment for all the periods up till here. That means we are doing adjustment for all that means we are actually adjusting all of these things which have happened for this period. Yeah, is that okay to everyone? Is everyone okay with this? Are you people okay with the computation of the adjusted capital employed? Are you people okay? Yes, the adjusted capital employed shall be up till 31st May 2019, 31st December 2019. Yeah, is that okay to everyone? Okay. When I talk about the intangibles, you see what happens is there are many expenditures like R&D, the research costs, etc., which are generally expensed out. But I told you that if it is expected to give you benefit for more than 12 months, that means you don't have to treat it as an expense. If you're not going to be treating it as an expense, then you need to add it up to the capital employed also. Then you need to add it up to the capital employed also. Okay now? Yeah, it's a corresponding adjustment. Okay, great. I think every one of you is now able to understand how we establish the economic value added. So you've got the handouts, and from the handouts, what you could do is that you could access the questions. And the question that I'm going to be using are, one of them is the question name is still water services. So we're going to be using this question, the name of which is still water services. I think you people have the access to this question. Kindly open up this question and we shall start discussing. Okay, don't worry about this specific issue of tax. I'm just going to explain to you. Don't worry, we'll cover up this thing in this question. Now, we have got this question still water services. There are multiple things with respect to the still water services. There are two requirements majorly. One of them is evaluate the performance of still water services using EVA. One of the requirement is you have to evaluate the performance of still water services using EVA. Now that's the one thing. The second thing is assess whether still water services meets its regulatory ROC target. So we are going to come on to that a bit later. But for the time being, the first thing that we need to cover up is basically still water services. The first thing is we need to cover up is the still water services using EVA. So what does this mean? This means you have to calculate EVA and then you have to comment whether the entity's performance is good or whether the entity's performance is bad. That's what you have to do. So now let's just try to calculate the EVA. I am giving you 5-7 minutes. So you take this reading time and try to calculate EVA. So you've got the question time. Till this 5:17 p.m. Kindly go through the question and then we'll start discussing. Okay, so let's just start off. Let's just start discussing about this specific question now. First thing is, we have to calculate the economic value added. We have to evaluate the performance using the economic value added. Now, let's talk, let's discuss. Basically, it says that still water services has got this revenue, which is 345 million, has got the operating cost, which is 277. So it has got the operating profit, which is 68. What is it? The operating profit, which is 68. And then there is this finance cost, which is 23. So resultingly, the profit before tax of 45 is there. The tax at the rate of 25% is this 9.5, and then the profit after tax is this 35.5. Now, you see, I told you people that when we are going to be calculating the NOPAT, you can start off with the operating profit, and from the operating profit, what you could do is that, let's say, if you've got an operating profit of 1,000, you've got an operating profit of 1,000, and you apply tax at the rate of 25% to it, so it's actually going to be 250. Resultingly, it's going to be PBIT 1 minus T. Now, the alternative way of doing it is what? For example, you've got a PBIT of, let's say, 1,000, and you've got interest of, let's say, 200. Resultingly, the profit before tax turns out to be 800. And you apply tax to it at, let's say, 25%. So it actually becomes what? 200. And hence what happens is you've got the profit after tax of 600. So if I have to start calculating the NOPAT, I'm repeating, if I have to start calculating the NOPAT, I've got another way of doing it, which is I can start off with a PAT of 600. And what I could do is that I could add up the after tax interest. I could add up after tax interest. The after tax interest that I need to add up is basically going to be what? It's going to be 200 multiplied 1 minus T. So 1 minus 0.25. So this is actually going to be 150. And hence you would again be standing at, what? You would again be standing at this PBIT 1 minus T. You would again be standing at PBIT 1 minus T. Is that okay to you? Yeah, is that okay to you? Okay, now let's talk. So we have got this operating profit. So you see, you've got these two options. Either you can do it this way or you can do it this way. But make sure that this tax has to be all the cash expense. If there is any non-cash portion of the tax, then that needs to be adjusted. You have been given the capital employed from the published account 2012, 2011, both 36, 37, etc. Now let's talk about each one of them. So we are being told about the operating cost. I'll read through the question, then I'll attempt. We have been given the operating cost, which is depreciation, provision for bad debt, R&D, and other non-cash items. We are being given economic depreciation, and we see is that economic depreciation only includes any appropriate amortization adjustments. It says in previous years, it can be assumed that the economic and the accounting depreciation were the same. What does this line means? This line actually means that if you are going to be calculating the opening capital, so you need to keep this thing in mind that the accounting depreciation to date and the economic depreciation to date, when you would add up this and you would deduct this, so resultingly what happens is if this is 1000, then this is also 1000. So hence what happens is there is going to be no impact of it. Let me repeat, there is going to be no impact of it. Is that okay to you people? Now let's move, let's discuss further. Now, the next thing is it says tax is the cash paid in the current year 9 million and an adjustment of 0.5 million for deferred tax. So we are not going to be considering the deferred tax. Why? The reason being there is no point in considering the deferred tax because it's a non-cash item. It says there was no deferred tax balance prior to 2012. Further, the provision for doubtful debt was 4.5 million on the 2012 balance sheet. So we need to see what was the opening provision for doubtful debt. We'll consider this. Now, R&D is not capitalized in the accounts. Okay, it relates to new development that will be developed over 5 years and is expected to be a long-term benefit to the company. 2012 is the first year of this project, cost of capital, gearing, etc., etc. Now, before I start attempting this question of still water services, there are few things that we need to understand. What are those few things that you need to understand? Try to understand this. There is actually going to be NOPAT less WAC multiplied by capital employed. So when we are going to be calculating, when we are going to be talking about the NOPAT, when we are going to be calculating the WAC, we need to keep this thing in mind that what is the WAC going to be. We have been given the cost of capital of assets, equity and the debt, the gearing and the debt. So the WAC is cost of equity multiplied by market value of equity divided by market value of equity plus market value of debt plus KD 1 minus T multiplied by D upon E plus. So hence resultingly what happens is we now know this thing which is 16% multiplied. The market value of equity is 0.4 divided by 0.4 plus 0.6 plus the cost of debt pre-tax. That means this is before tax. 5%. We'll multiply it by what is the tax rate? 25%. So it has to be 1 minus T. So you multiply it by 0.75. And then multiply by 0.6 divided by 0.4 plus 0.6. So can somebody please calculate the WAC? Can somebody please revert back with the value of WAC? Yeah, can somebody please confirm to me what's the value of the WAC? 8.4. Okay, I am getting very different answer. I cannot decide on anyone. You people are calculating. Every one of you is calculating a different answer. Okay, I've got two answers. No, no, no. In fact, no, none of the answer is matching. Please do the calculation, please. Okay, yes, I've now got two of the answers which are matching, which is 8.65%. So I would rather consider it to be 8.7% to make things easy for myself. So we have got the weighted average cost of capital as 8.7%. How much is it? 8.7%. Now, the next thing with respect to this question is that you have to, why did I calculate this? I calculated this just to make sure. I'm repeating it again. I have calculated this just to make sure that I'm able to get maximum marks by doing the easy calculations. Let me repeat. I calculated it just to ensure that I got the easy marks by doing simple calculations. Now let's move a bit forward and discuss further. What next is there? The next situation is, it's actually like this. You have to calculate the NOPAT. For the NOPAT, you can start off with the operating profit. The operating profit is given to us, which is 68. The operating profit is given to us, which is 68. So 68 is the operating profit. You could simply perform the adjustments. We have got the finance charges here. Now what happens is when you claim the finance charges, when you claim the finance costs, so what happens is there is actually going to be a tax savings due to interest that you would have to consider. What is that tax saving due to interest? The tax saving due to interest is going to be 23 multiplied by 25%. That's actually going to be 23 multiplied by 25%. Less the tax saving due to interest. How would we calculate it? We would simply say 23 multiplied by 25%. So this actually gives you 5.75. The next thing is we have got the taxation. Here it's 9.5, but you would only deduct the tax paid, which is 9. Why? Because 9.5 includes 0.5, which is a non-tax, non-cash expense. Then what happens is, if I go on calculating the operating costs and so, I'll use this column. I've got the add back amounts of accounting depreciation, which is 59. I've got the add back amount for the provision for bad debt, which is going to be 2. I've got the research and development, which is going to be 12. I've got the other non-cash items, which is going to be 7. So you're gonna add up all of them. Then you've got the economic depreciation, so you would deduct the economic depreciation of 83. The tax paid is okay. The provision we considered, this we considered okay. So resultingly, what you would have is you would end up getting the NOPAT. What do you do that? You would end up getting the NOPAT. So how much is this NOPAT going to be? Let's try to calculate. Let's try to establish. You will end up getting the NOPAT. 68 less 5.75 less 9, add 59, add 2, add 12, add 7, less 83. Can somebody please confirm the value? Yeah, can somebody please confirm the value? Thank you, Muhammad Qayyum. Thank you very much. It's going to be 50.25. It's going to be 50.25. Is that okay now? Okay. Now what next is there? Let's try to understand. The next thing is, okay, you see, you don't take Mr. I don't know if you are male or female. I just say Amrita Otal. What actually happens is you have to consider what has been included in the profit calculation. And when it comes to the profit calculation, the amount that has been included has been 2 million. Okay, now let's move. Let's discuss further. So we have got the NOPAT. Now what we need to do is that we need to calculate the adjusted capital employed. So if I'm going to be calculating the adjusted capital employed, how am I going to do it? Let's just see. For me to be able to calculate the adjusted capital employed, I would say that first of all, as per the balance sheet, this is 2011 capital that I'm going to adjust. Why? Because we adjust the opening capital. So it's actually 637. How much is it? 637. Now what next is there? You need to incorporate the adjustments. What do you need to do? You need to incorporate the adjustments. What are the adjustments that you need to incorporate? That's actually, let's just think about it. Let's just talk about it. First of all, for the accounting depreciation and for the economic depreciation, there is no adjustment that you have to make because They were equal to each other in the past. Then what happened is we need to work for the provision for bad debt. So whatever the opening provision for bad debt, we need to consider that. For the provision for bad debt, the opening figure we don't know. The expense for the year we do know it's 2. The closing balance, are we being told about the closing balance? I think yes, it was 4.5. So hence what happens is this is the balancing figure, which is going to be 2.5. So this was what it was at 30th September 2011. Is everyone okay with this? So what I am going to do is that I am going to say the provision of 2.5 needs to be added. Now, the next thing is research and development, just ignore it. Other non-cash items, the last year. The non-cash items which were incurred in previously needs to be added back. Then you have got this R&D which has arisen in the current year. So we need to ignore it. And hence resultingly you get this capital employed and adjusted calculation. How much is it going to be? 645.5. How much is it going to be? 645.5. Now let's try to have an understanding. Okay, now next. The next situation is, with respect to the next situation, you now need to establish the economic value added. So we have got the NOPAT, which is 50.25, less the WAC, which is 8.7, multiply by 645.5. So how much do we have? We have got 645.5 multiply by 8.7%. This is something like negative. How much is it? This is negative. This is negative 5.90. Now, so we have established the EVA to be negative 5.90. And if the examiner is asking us, to establish, evaluate the performance using EVA, so evaluating of the performance would mean that the first thing is we need to calculate it, and then we need to comment on it. Now, what exactly is going to be the comment? The comment is going to be that when we are going to talk about the comment on it is going to be that the performance has been bad, the value has declined, because a negative EVA would mean that the value has declined. The value has declined. Is that okay to everyone? Yeah, is everyone okay with the calculation? I hope you would have gotten some confidence after doing the calculation as of now. Okay, this is great. So we did this question which was about the economic value added. There's another requirement to the question which I'm not going to be considering right now, because my focus has been that I should talk about the EVA computation and etc. etc. Yes, Qayyum, don't worry about it. Now, I have shared with you people, few of the articles on the economic value added. There is this part 1 of the article which covers up the EVA calculation. You can go through it just for the sake of going through it. There is part 2 of the article which has to be read by every one of you because it covers the theoretical aspect of the EVA. I'm repeating, it covers the theoretical aspect of the EVA. So you should be going through it. You should be going through it because it covers disadvantages, advantages, etc. etc. You should be going through it. And then there is another article which is about value-based management, which I'm going to cover up in a bit, which I'm going to cover up in a while. So don't worry about it. But you have to make sure that this is something that you should be going through. Now, let's move a bit forward. Let's talk a bit further. So we have gone through one of the questions on the economic value added. What have we done? We have talked about the economic value added. Muhammad Hassan Ali Khan, your question. All the adjustment for capital employed is done for previous year. Yes. Nothing from current year. No. Mahaz Ali, you are saying we come cross with the terminology shareholder value creation. That is RI, ROC does not measure value for shareholders while EVA does. Yes, yes, you are right. You are right. I mean, because EVA is a better measure of establishing the, I mean, you see, if residual income is positive, we assume that the return achieved is over and above the return desired by the provider of finance or the investors. But for the EVA, you're using WACC, you're using the realistic economic profit. So EVA is a better measure telling you that whether the value has been added or not. So if you are going to take decision with respect to EVA, always remember, if the EVA is positive, that means the value has been created. If the EVA has been 0, no value created. If the EVA has been negative, so that means the value has been destroyed or the value has been deteriorated. That's what you need to keep in mind with respect to the EVA computation. Is that fine now? Okay, great. Now let's move forward. You have got another question in hand, and the name of that question is Totac Company. The name of that question is Totac Company. Okay. And what I would be doing is I'd be taking a short break for the prayers. So the time, which is the Pakistan time right now, is 5:50 p.m. So I'll take the break till 6:05 p.m. I'll take the break till 6:05 p.m. So let's meet after break. Okay, now let's talk about this question, the name of which is TOTAC company. There are two aspects that are being covered with respect to this question, TOTAC company. What exactly are they? One of them is about value-based management and the other one of them is about EVA. So the first requirement is advise the directors on the implementation of step 2 of VBM as requested. Okay. The second is evaluate both whether TOTAG has created value and the difficulties of using EVA as a performance indicator. Now, what exactly are we going to be doing with respect to this question is that it says evaluate whether TOTAG has created value. So that means you would have to calculate the EVA and the difficulties using EVA. So you would have to identify the problems or the limitations of using EVA as a performance measure. So there are two things that you have to do. One of them is you have to identify whether TOTAG has created value or not. And the second thing is the difficulties of using EVA as a performance measure. So let's talk. This is the relevant portion of the question. It says directors are unsure of suitable performance indicator for them to use to measure whether TOTAG is creating value. As an illustration, they have asked you to evaluate by calculating economic value added. Whether TOTAG has generated value or not, you should use the financial information given in the appendix 2. You should use the financial information given in the appendix 2. Now, so the appendix 2 is here. We need to calculate the EVA using this information. Can you just do the quick calculation? I'm just waiting for you people for 2 minutes. Can you just do the quick calculation, please? Madhuri, don't worry. I'll just go on to the VBM. Just don't worry. I'll explain the entire value-based management. You don't have to worry at all. You don't have to worry at all, please. Okay, now, so if I calculate the economic value added, I've been given the operating profit, which is 10,000, the interest expense 1,500, the profit before tax, the tax at so and so, the profit after tax. Now the notes, it says that during the year 450,000 of advertising cost, which will generate sales in future periods, was expense to the income statement. So if I try to calculate the NOPAT, I could do the NOPAT calculations like this also. What exactly are going to be the way? You would say profit after tax 6630, and with the profit after tax you would say what? You would add up after tax interest, the 1,500 interest multiplied by 1 minus t, 1 minus 0.22. So if you would add up the after tax interest, what is it going to be? It's 1,500 multiplied by 1 minus 0.22. So it's actually going to be 1170. Now, in addition to this, what is actually going to happen is, you've got the profit after tax, then it's actually the after tax interest which needs to be added back. Furthermore, what happens is there is going to be the advertising cost of 450 which needs to be added back. Then what actually happens is it has to be allowance for doubtful debts at the end of the period was this, a reduction of 200,000 from the beginning of the period. So if there is a reduction of 200,000, so this is actually an income that has been recorded. So what we need to do is that we need to remove it because it's an income that has been recorded. Capital employed at the beginning, we'll see that the after tax weighted average cost of capital was this, companies financed by this. Directors are considering changing policy or depreciation for the year ending so and so. Now, on the basis of available information, let me repeat that on the basis of available information, this is what our NOPAT is. Let me repeat, on the basis of available information, this is what our NOPAT is. Now, what exactly is this NOPAT? Let's try to have an understanding. Okay, it's actually going to be what? 6630, add 1170, add 450, less 200. So how much is it? 8050. Okay, it's 8050. We are adding interest. Okay, there is a question that why are we adding interest? Let me explain to you. Just wait a minute. Just wait a minute, please. Can we also do the calculation for the capital employed? So the beginning capital is 88944 because we are working in terms of thousands. It's 88944. Then what happens is you need to perform the adjustments. This advertising cost is for the current year. We had an allowance at the end of the period was 500,000, reduction of 200,000. So if you talk about the provision for bad debt, what was the opening provision? We have a closing provision of 300,000. There was a reduction of 200, so that means there was 500 at the opening. So 500,000 is the provision for bad debt that was existing. Resultingly, what happens is it's 88944 plus 500. What is it going to be? 88944 plus 500. So hence, resultingly, what happens is it is 89444. What is it going to be? It's going to be 89444. Okay, now, so how exactly are we going to be calculating the economic value added? It's going to be 8050 less 89,444 multiplied by the WACC, which is 9%. So hence what happens is 89,444 into 9%. Hence 89,444 multiplied by 9%. So if you say 8050 less 89,444 into this, so it's 0.04. So if you try to establish the economic value added, this is what you have got. If you try to establish the economic value added, this is what you have got. Is that okay? Now, yeah, provision for bad debt is being added because it was previously deducted and it's non-cash. Yes, the opening one is to be added up. Okay, now there's a student who is asking that why have you added back interest? So let me actually explain to you. Now, see what happens is when you calculate the net present value, how do we establish NPV? How do we establish NPV? When we are establishing the net present value, so how do we calculate? We use the cash flows, and the cash flows are multiplied by the discount factor, so you end up getting PV. And when we are calculating the cash flows, we don't deduct interest in that. Why? Can you tell me the reason why? Yeah, can you tell me the reason why? Tendai Mopande, can you tell me the reason why? Why don't we deduct interest in the NPV calculation, please? Due to present value or what? I mean, Miss this Tendai Mopande, can I have your answer? Okay, let me explain to you. Few of you have answered it correctly. We don't consider interest because the discount factor, which is the weighted average cost of capital, already includes the effect of interest, already includes the effect of the cost of equity. That's what it already includes. So the same concept is applicable in the economic value added also. Now, what is that same concept? Here what happens is, this is the weighted average cost of capital that we are incorporating. We are saying the profit less the capital multiplied by the weighted average cost of capital. So if you have got the profit multiplied by the weighted average cost of capital, so that means you are already incorporating the effect of interest here. So if there is any effect of interest here, that needs to be removed. If there is any effect of interest that is prevalent over there, that needs to be removed. Yeah, is that okay? Okay, great. Now, so we have now, thank you, Amrita. Now, we have now got the economic value added, which is 0.04. And the requirement was that you have to advise, evaluate whether TOTEC has created value and the difficulties of using EVA as a performance indicator. Now, when it has created value or not, so yes, it has created value. The difficulties of using EVA as a performance indicator, I'm not going to spend time on it. It's a theoretical aspect. It's available in the technical article that I shared with you a while ago. So you can get access to it over there also. So I don't think that I need to go through it because it's there, like the problems, the challenges, etc. So you can actually look at it from here. I'm not going to go through it. The reason being that it's going to then end up taking a lot of time of us. So now the next requirement is, it says advise the directors on the implementation of a step 2 of the value based management as requested. One of the students amongst you people actually commented that the value based management is a very complicated topic. So we would appreciate that if you could also explain the value based management. So I'm going to do that. I'm going to explain to you the value based management, uh, that what exactly the value based management is all about. So for that, what I would want you people is to refer to this specific article also, when you would be going through at your home, when you would be wanting to read further. But what I'm going to do is that I'm going to explain to you the VBM right now, that what exactly this VBM is. Okay, now, so if I talk about the concept of value-based management, let me explain to you that what exactly do we mean by this value-based management. When we talk about the value-based management, so you see, value-based management is a management technique. Value-based management is a management technique which focuses upon value creation. So value-based management is a management technique which actually focuses upon the value creation. Now, the first and the foremost important thing is, what exactly do we mean by value? So when we talk about the concept of value, so the value actually means that the value is created when an entity generates returns over and above the returns desired by providers of finance. So if I talk about the value-based management, I'm going to tell you that the value-based management is a technique that focuses upon the value creation. What it does is it focuses upon value creation. And what exactly do we mean by value? So that says the value is created when an entity generates returns over and above the returns desired by the providers of finance. Now, what exactly do we mean by this? This means that if the entity is generating a positive NPV, that means it is creating value. When it is generating the positive residual income, it's generating value. When it is generating the positive EVA, it is actually calculating the value. Why? Because these usually incorporate the return desired by the providers of finance. Now what next is there? Yes, it's just like NPV. Now, so basically what happens is the value-based management is, again, it's a technique where the focus is upon value creation. But when it comes to the creation of the value, we need to understand that there has to be multiple measures of creating value. What are those multiple measures of creating value? So usually the value-based management uses economic value added. The value-based management uses the shareholder value analysis, SVA. The value-based management uses MVA. These two things are not part and parcel of the course. It's only the economic value added which is part and parcel of the course. So first of all, you need to understand that EVA is a high level performance measure used in VBM. So when it comes to the value-based management and the EVA, the important thing is value-based management and EVA are not the same thing. EVA is part and parcel of value-based management. EVA is part and parcel of value-based management. So if you are applying, if you are implementing value-based management in any organization, that means EVA could be one of the ways of using it. Now, what's the next thing? Try to understand this. The next thing is, how does this value-based management leads to the creation of the value in any organization? So with respect to the value-based management, there is a 4-step approach that a value-based management technique adopts in order to implement, in order to create value. What is this 4-step approach? When I talk about the 4-step approach, so the first thing is the strategy, producing a strategy. So the first thing is strategy development. The second thing is defining performance targets. The third one of them is creating a plan to achieve the targets. And the fourth one of them is setup of the performance measurement and the reward system. Now, try to understand this thing, that how the economic value added, how this value-based management would be implemented in any organization. So let's try to understand this. For example, the strategy is maximize shareholder wealth. Sorry, this is the overall objective, that maximizing the shareholder wealth. Now, if the shareholder wealth has to be maximized, so what is going to be the strategy, which is the course of action, which is going to be adopted in order to achieve this specific strategy? So assume that the entity may actually say that reduce cost of production per unit. Reduce cost of production per unit. Now, if this is one of the ways which is reducing the cost of production per unit, so this is the first step. What? It's the development of the strategy. Now, what is the second step? The second step is basically you have to set the performance target. So if you have to set the performance target, then what actually happens with respect to the setting of the performance target is, maybe you could say that reduce cost by 20% in 3 years. So that's actually the performance target. The third one is the plan to achieve the targets. Now, the plan to achieve the target, how exactly would you be able to reduce the cost by 20% in 3 years? So maybe what you could do is that you could think about alternate material. You could think about training employees. You could think about the efficient machine. You could think about the waste recycling. So these could be the multiple things which are going to ultimately lead to reduction in the cost. And the fourth step is going to be the performance measurement. The fourth step is going to be the performance measurement. And when we are going to be talking about the performance measurement, so you would actually be introducing a measure for this. You'd be introducing a measure for this. You'd be introducing a measure for this, a measure for this, a measure for this. So if you actually look at this value-based management, the objective is value creation, but the approach is more or less similar to that of a balanced scorecard or the performance pyramid, because usually what happens is the performance pyramid, what happens is we consider the operational level, we consider the tactical level, we consider the strategic level. We know that this is going to perform, this will benefit. If this will benefit, this will benefit. Same thing happens with the value-based management. You perform at this level. This performance is reflected here, and this performance is reflected here. So ultimately, the value-based management would have an ultimate value creation as an objective, as a thing. But then again, it could focus on both the financial and the non-financial aspects. Okay, there is a question that can you please give an example of how would you measure the waste materials and the training of employees? So the training of employees could be the number of training hours, then at the same time it could also be the time taken to produce an item. The abnormal loss could be measured, that how much was the abnormal loss percentage earlier and what is the abnormal loss percentage now. Wastage could be customer returns also, yes. Tender, you are right. So I hope that you people are able to understand the value-based management now. Mazali, is it okay now? Mazali, is it okay now? Yeah, is it okay now? Well, the activity-based management is something else. Just wait for it for tomorrow, probably. Okay, now. So this is how the this is how the value-based management is implemented. Now, let's move a bit forward and discuss further. The requirement was advise the directors on the implementation of step 2. So it says TOTAG manufactures high quality and innovative small electrical appliances, such as hair dryers and vacuum cleaners. So what does TOTAG does? It manufactures high quality and innovative small electric devices and so on and so forth. Now, it says all of the board of directors who are the strategic decision makers have always worked in the business and are members of the TOTAG family. Most of the operational managers joined as factory workers when the business started and have taken on more responsibility as the business has grown. Totag has a basic and an outdated IT system for business of its complexity and has always used traditional financial performance measures such as the return on investment and the operating profit margin. So what they have done is they've majorly used the return on investment and the operating profit margin. Now, it says today Totag has historically had few competitors, and the directors have focused on improving financial results from one year to the next. So what does it tell you? It says that okay, it says that a number of overseas competitors have, however, recently entered into Totag's market. It is estimated that within 1 year, these competitors will be able to produce at a similar unit cost to Totag, and that within 3 to 5 years, the quality, within the 3 to 5 years, the quality of the competitors' products, the quality of the competitors' products will be comparable to the current quality of Totag's products. Now, what next is there? It says Totag may have to invest heavily in product development and make acquisitions in the future in order to compete effectively. So they have not had competition, but they are now going to have the competition. They are now going to have the competition. Now, what actually happens is it says a consultant has recently told the directors that implementing VBM may help Totag to respond to increase in competition over the next 1 to 5 years. Consultant has defined VBM as the alignment of business strategy, management processes, and culture on maximizing shareholder wealth by focusing on key drivers of value. Directors have accepted this as a reasonable definition of VBM, and most of them now agree that VBM would be useful, though others are not yet convinced. The others are not yet convinced. Now, what else does it say? It says that it says that directors have asked you for further advice on one aspect of implementation of VBM at Totag at a recent presentation. Consultant presented a slide showing the 4 steps. Directors want your advice on how to implement step 2, which is defining performance targets. Your advice should focus on following areas: selection of appropriate measures and targets, time scales to which the target should relate, management levels, operation in which the target should relate, and difficulties in measuring and management performance using VBM. So it's actually more of a, what they want is they want that we produce the answer with respect to defining of the performance targets, defining of the performance target with respect to the selection of measures and targets, time scales, management levels, so on and so forth. Now, you need to try and understand this thing, that what is actually going to happen in this specific question. Okay, now the first thing is firstly, what happens is selection of appropriate measures and targets. So first thing is you need to tell them that, look, Your targets have to be financial and non-financial both. The second thing is the return on investment and the operating profit margin. They are probably outdated. They are of no use. You should rather focus upon cost reduction, and at the same time you should have targets which measure the quality also, because you just can't go on reducing the cost. So basically the financial and non-financial aspects plus cost reduction and quality, these are the things they must be considered. The next thing is, what should be the time scale? Always remember, short-term and long-term targets need to be set. Like maybe possible, for example, there could be short-term and the long-term targets, both need to be set. What exactly do you mean by this? Let's try to understand this. Basically, this would mean that since there is a 1-year target, there is a 3-year target, there is a 5-year target, all of these targets need to be set. All of these targets need to be set. Furthermore, it says the management levels in the business to which the target should relate. Ideally speaking, it has to be the all levels of management, because it's the operational, then the tactical, and then the strategic level goals, because it has to be here, it has to be here, and it has to be here. All three levels across the organization should be set the target. Difficulties in measuring and managing performance using VBM. It's basically the first problem is about the information system. The lack of understanding and experience that the management may possess. A lot of EVA related issues like WAC, economic depreciation, etc., they could be the different type of things that need to be used. WAC, economic depreciation, etc. So when the examiner is asking us that what could be the difficulties in implementing this step 2, so the difficulties in implementing the step 2 could arise from these various aspects. Yeah, is that okay to everyone? Okay, great. So we are going to answer this specific question like this. Could you please be more specific in relation to difficulties for each of these, accepting the reluctance to change and the level of complexity for EVA? Well, okay. Now, because also this value-based management would need you to have a good information system which could capture all the information and report to you. Unfortunately, you don't have a proper system. You have an outdated IT system. You have an outdated IT system. You don't have a proper system, unfortunately. Is that okay now? Okay, great. So we are done with this question. We have covered up value-based management, and we have also covered up the economic value added, and I believe that you people would have got much confidence with respect to this area, because EVA is generally one of those areas where a lot of students, they struggle, they have problems in tackling the EVA. Amamen sir, thank you very much for your comment. We are probably heading into the final day of this session tomorrow, but you don't have to worry, because my support is going to continue with you people, and I'm going to continue to help you people prepare for the exam, and inshallah, as much as I can help you till the last day of the exam, and you will be getting my support, inshallah, to the maximum possible extent. For those of you who haven't joined in the WhatsApp group, you can join the WhatsApp group, or maybe you could message me on this number. And I am going to get you added to the WhatsApp group. So basically, that's it from my side. I really thank you very much, all of you. Would really appreciate to have feedbacks from you. If you could share your feedback of today's session and also any further suggestions. Yeah, would really appreciate if you could share your feedback of today's session and the further suggestions for the subsequent session and etc. No worries, Asad Bhai, they are all going to be uploaded, so you can view them. Amrita, thank you very much. Tendai, okay, you can get in touch with me. Good enough, Ramiz, alhamdulillah. So that's it for today. Thank you very much, everyone, for your time. Thank you very much for being here. Really appreciate that you people take out time, because ACCA has taken the initiative, and it's actually for you people, and it's like that. That's why they're making the recordings available to you also, so that you can always look at them. The plan for tomorrow is going to be a mixture of some divisionalization, some transfer pricing, some activity-based management, something like that. So we're going to continue inshallah tomorrow. There are a few more things that need to be covered up. You don't have to worry further. I'll cover them up inshallah in the coming sessions. So thanks a lot for time. Thank you very much. See you tomorrow inshallah. End कर दे।